The key point about the global economy is that capex is shrinking, global earnings are shrinking, manufacturing globally is broadly in recession, and there's weakness spreading from emerging markets across the world, and it's feeding back into the US economy. And so we're beginning to see that weakness showing up primarily through the transmechanism of a stronger dollar, but also as the Fed continues to tighten monetary policy. So we're seeing it there. We're also seeing it through companies' earnings, which are shrinking. The profit share of GDP has peaked in Q1 2012. Even if you strip out energy, the profit share is shrinking. It's another way, of course, of saying that margins are compressing, and generally you get a recession 2 to 3 years after the peak in margins. And some of that's the dollar strength, as I said. Some of it's a rising cost of capital. But the key source of pressure on US companies is coming from rising wages in a low productivity environment. And of course, by definition, that is a profit squeeze. So it's key then that we see the labor market continuing to tighten up. Job openings are accelerating higher. Wage growth on a number of indicators is picking up. So if you look, for example, at the Atlanta Fed data, and this is squeezing earnings, and we've got a number of indicators to show that pressure. And ultimately, all recessions are about is companies experiencing shrinking profits, and then you see a building impetus on those businesses to retrench, tighten their belts. They draw down inventory, they cut capex, and then eventually they shed jobs. So we're looking for a mild recession, not something like 08 and 09, something more like 2001 or 1990. So a mild, shallow recession. But with that, of course, a bear market in equities, which in our view has already begun, but that continues. And then, of course, an ongoing bear market in other global equities and an outperformance of the defensive parts of the risk spectrum. Yeah, so that's a great question because, of course, the counter is that if you get wage growth and that feeds back into better top-line revenue growth, then that prolongs the economic cycle. And I'd suggest there are two prongs of evidence, if you like, to suggest that it's not likely to happen. And the first prong is that despite the sharp fall in the oil price, we haven't seen a pickup in spending. So consumers have saved the gains from the oil price fall. In fact, the gains of lower gasoline prices and other energy costs is about 150 billion. About 90% of that has shown up in an increase in the flow of savings from households. So they're saving it. Why are they saving it? Because because households are structurally weak. Incomes across quintiles of earnings have been going down for 15 years. So the consumer has essentially been in recession on that basis for 15 years. They've been deleveraging. If you look at retail sales growth, sure, they bounced following the crisis in 08, 09, but actually retail sales growth has been trending down for years. 45 million Americans are still on food stamps. That's pretty similar to the levels a few years ago. So the average consumer hasn't had a recovery in this cycle, and they're structurally weak. The Fed survey out a couple of weeks ago suggested that most Americans can't even afford to pay a $400 emergency medical bill. They don't have the cash to do it. So they're short on savings, and they get a bit of a gain from the oil price fall, and their impetus is to save it, not spend it. And then the second prong of evidence is what we see in the labor market, which has become increasingly dominated by the older cohorts. Without the 55 and over group in employment, the number of people in employment in the US is smaller today than it was in 2007. I had to run those numbers twice because I was so shocked. The other key point is that most of the wage gains in this cycle have been accruing to the 55 and plus category, which is very unusual, but it's massively negative for the US economy because the older groups have a high propensity to save. The younger groups, they're not growing in numbers and they're not growing in wages. Those are the groups with high propensity to spend. So it's a negative outlook for companies in a world where productivity is low and wages are creeping higher because it generates a squeeze on profits and it puts more pressure on companies to retrench, which of course is the heart of a recession dynamic.